Welcome to 3 Daily News. The door didn't slam shut. It was sealed quietly, but ruthlessly. In early 2025, China imposed a 10 to 15% tariff on U.S. crude, LNG, and coal. Almost immediately, Chinese refiners walked away from American energy, turning instead to barrels from Russia, Saudi Arabia, the UAE, and even Iran. By mid-year, U.S. shipments to China had virtually disappeared, replaced by yuan-based contracts and fresh alliances. This wasn't just a trade spat, it was a reset of the global energy map. With China moving away from the dollar and redrawing its oil network, American producers suddenly found themselves locked outside, watching the world's biggest oil market function without them. Here's how the shutout happened, and why the U.S. may never find its way back in. Tariffs ignited the collapse of U.S. oil trade. In February 2025, China hit U.S. crude with a 10% tariff, and LNG and coal with 15%. Overnight, refiners stopped booking American barrels. Even at heavy discounts, shipments went untouched. The numbers told the story, from roughly 160,000 barrels per day early in the year to almost nothing by mid-2025. There was no big announcement, just silence. Contracts expired, bookings dried up, and tankers sat still. Even a temporary 90-day truce cutting tariffs back to 10% couldn't revive flows. The economics, and the infrastructure, had already shifted. This wasn't just lost volume, it was a structural retreat. Export terminals, pipelines, and shipping routes built around China went underused. American producers, once confident in their Asian expansion, were left scrambling for buyers in a world that had already moved on. Analysts didn't call it a slowdown, they called it a turning point. Meanwhile, China recharted its oil compass. As U.S. barrels vanished, Russian crude surged in, sidestepping Western sanctions. Saudi and UAE oil filled the gaps with long-term stability. Even Iranian crude, often shipped through shadow fleets, gained traction, especially with China's independent teapot refiners. By mid-2025, estimates showed China importing over 1.7 million barrels per day of Iranian oil, much of it slipping quietly past global oversight. And these weren't stopgaps. They were multi-year yuan-based contracts that rewired payment systems, supply chains, and refinery operations around non-U.S. sources. China's refinery activity jumped too. In June 2025, throughput rose 8.5% year-over-year to 15.15 million barrels per day, the highest since 2023. With 4 straight months of surpluses above 1 million barrels daily, refiners had room to store or export at will. What followed was deliberate and precise. Pipeline routes, payment rails, and blending specs were all re-engineered. The U.S. wasn't replaced in panic, it was systematically cut out. For American producers, that exclusion now looks permanent. But energy is just one part of the equation. Behind this trade rupture lies something even bigger, a quiet financial revolution. Because while barrels shifted hands, so did the currency used to pay for them. The dollar, once the default language of global oil trade, is slowly being edged out. In its place, China's yuan. Backed by digital payment systems, bilateral swap lines, and regional trade pacts, Beijing has been laying the groundwork for years, and 2025 is when it started to click. Think about it. Every time China pays for oil in yuan instead of dollars, it chips away at Washington's leverage. Every time a refinery signs a long-term yuan contract, it locks in a future where the dollar isn't the only gatekeeper. And every time sanctions push nations closer to China's financial orbit, the more this alternative network solidifies. This isn't just about saving money on exchange rates. It's about financial sovereignty. Beijing's answer to decades of dollar dominance. And if energy, the world's largest traded commodity, can be pulled into that orbit, then what stops other sectors from following? So the real story isn't just tariffs or tankers. It's a shift in the gears of global finance. A move from a single U.S.-led highway to a multipolar system where power is divided and the rules are rewritten. And the question we need to ask is simple. If the dollar loses its grip on oil, what else slips away with it? Stay tuned, because next, we're breaking down how de-dollarization is reshaping global trade and what China's drive for financial independence means for the world economy. China's new energy play isn't just about shifting barrels. It's about shifting currency. In 2025, long-term oil contracts with Russia, Saudi Arabia, Iran, and the UAE are increasingly denominated in yuan. sidelining the US dollar and expanding Beijing's financial footprint across global energy markets. And make no mistake, this isn't symbolic, it's structural. UN-based deals reduce exposure to dollar-linked risks, sanctions, and political interference. They're reshaping the entire system, from how oil volumes are booked, to how payments are cleared, to how insurance is secured. The leverage Washington once enjoyed through dollar dominance, dictating pricing power and enforcing sanctions, is slipping. Analysts report a steep rise in non-dollar contracts this year, which makes it harder for American suppliers to compete, even when offering discounted oil. Because here's the harsh truth. With China's financial ecosystem now tailored for UN-based transactions, American oil isn't just less attractive, it's becoming incompatible. U.S. crude isn't just excluded from the buyer's list, it's excluded from the system itself. And that raises a bigger question. Even if American barrels get cheaper, how do they re-enter a supply chain that's been custom-built to operate without them? Infrastructure on standby, a scramble to recalibrate. For years, U.S. energy infrastructure was constructed with a single objective: to feed China's booming demand. From Gulf Coast terminals like Ingleside and Loop, to pipelines engineered for Asia-bound exports, America's fossil fuel ambitions were welded to Beijing's growth. But by mid-2025, with Chinese refiners slamming the brakes, all of that meticulously laid groundwork now sits idle in neutral. Redirecting supply to Europe, India, or Latin America might look like a solution, but it's not that simple. These alternative markets are smaller, fragmented, and fiercely competitive. Margins are razor-thin, contracts are shorter, and geopolitics makes long-term planning a gamble. That leaves U.S. producers staring at underutilized pipelines, half-filled storage tanks, and shrinking returns. Infrastructure once built to serve Asia now looks like a race car without a track to run on. Industry analysts are sounding the alarm, unless something breaks. Whether through bold policy moves, geopolitical shocks, or a major trade breakthrough, the entire U.S. export model may need to be rewritten. Trade deadlocks and China's energy reboot. When U.S.-China trade talks resumed in Stockholm by mid-2025, energy wasn't even on the agenda. Washington threatened 100% tariffs on nations buying sanctioned Russian or Iranian oil. But, Beijing stood firm, asserting energy sovereignty and rejecting foreign pressure. A brief tariff rollback to 10% offered no real lifeline to U.S. exporters. China pressed ahead with long-term contracts, UN-based settlements, and aggressive stockpiling strategies. By mid-year, surplus crude inventories reached 1.42 million barrels per day, giving refiners a safety net to ride out volatility. And none of that surplus came from the U.S. Instead, it was filled with oil from Russia, the UAE, Iran, and Saudi Arabia, embedding China's reliance on rivals. Meanwhile, China's EV revolution shifted into overdrive. With over 14 million charging stations installed and nearly half of new car sales now electric, Beijing's forward-looking policies are eroding long-term oil demand itself. That weakens the future prospects for U.S. fossil fuel exports, even if geopolitics were to shift in America's favor. The result? This isn't just exclusion by policy, it's a full-scale energy realignment designed to leave U.S. oil behind. Verdict: the final turn. The U.S. didn't lose China's oil market in one dramatic crash, it slipped away incrementally, through tariffs, lapsed contracts, logistical rewiring, and above all, China's strategic choices. What replaced American crude wasn't just cheaper barrels. It was a fully integrated energy and financial ecosystem. Pipelines, contracts, payment systems, and reserves, all designed around yuan and shielded from dollar dominance. Even after tariff adjustments, China hasn't flinched. Its buying channels are optimized for Russian, Emirati, Iranian, and Saudi crude. Its EV adoption is cutting demand growth for oil altogether. The trajectory is clear. The future of China's energy system doesn't include American producers. Unless Washington delivers a bold new form of energy diplomacy, or Beijing decides to radically alter its roadmap, U.S. oil will remain parked at the curb. Your turn. Can America rebuild a competitive export strategy, or has the engine already stalled? Could China's EV push permanently undercut global demand for U.S. oil? Should American producers pivot more aggressively toward alternative buyers, or wait for a geopolitical reset? Drop your thoughts, counterpoints, or hot takes in the comments. This isn't just a report, it's a discussion. And if you haven't already, subscribe to 3 Daily News for more high-impact analysis on energy, trade, and global shifts shaping tomorrow. Thanks for watching. Check out the next video on your screen, and we'll catch you in the next one.